So thank you for being here, and I'm pleased to have been invited, and it's a great pleasure to actually finally make it to Royal Holloway College. Many years ago, those of you, I don't know whether we still have UCA forms these days, do we? Well, many years ago, I scribbled the name Royal Holloway College on an UCA form and was unceremoniously rejected. But here I am, a late developer. And made my way through a university career here, and I taught for a long time at Nottingham University. And it's being in an auditorium like this reminds me of my very, very first teaching experience, which was a Statistics 1 tutorial class with about 5 people there. Maybe it was 8 or 9, I don't remember the exact numbers now, but it was in the main lecture theatre, which is A48 in the Social Sciences building, ingrained on my memory. And there was no door like that, you had to come in from up there. And the stairs were sort of similar, it was laid out in the same way, and they're the type of stairs that you sort of find yourself accelerating as you go down. You see, faster. By the time you hit the front, you sort of got to put the brakes on. And I was fairly nervous, because this is the first time I'd been in this sort of situation. And I got in there, and the class was there, and they all sat at the back. Every damn one of them. And so I actually plucked up the courage to say, unless you come and sit at the front, this class is over. And they didn't get up and walk out, or I didn't have to walk out and eat my words. They didn't call my bluff. Fortunately, they came to the front. But I'm glad to see that we've got more than 8 people in here this morning. And hopefully I can tell you something in the next 55 minutes or so here that will be of interest to you. Andrew asked me to present, and I thought, well, the obvious and part of the theme of this conference is this interaction between OR and analytics and sort of figuring out what that all means. And I know it's going on in other OR societies around the world, because I gave a presentation last year at one of the Informs conferences in the United States, where I'm now based. So I will do my best to keep my best English accent going and not lapse into vernacular, having been there for 15 years now. And I thought what I would do is to talk about a day in the life of a credit card, and the way that analytics basically supports the credit card industry. If there were no analytics, there would be but go so far as to say there would be no credit card industry, but it would operate a lot differently than it does today. So before I do that, I have to go through this obligatory, who the heck is FICO, in case you've never heard of FICO, previously known as Fair Isaac, and still legally known as Fair Isaac. We're a technology company, but we're sort of unusual in some ways because we've been around since 1956, and we were founded by 2 engineers, one of which was an OR guy. So translation into analytics is very possible. We're a relatively small company in the big scheme of things, 750 something, roughly $1 million of revenue, about 2,500 people, and you've got offices around the world. Now, what we focused on as a company, and I think hopefully will become clear as I go through my presentation here, and it's not about FICO, so relax. But inevitably it's about sort of what we do. Is and this is, I think, key. The point here is not so much about us, it's sort of a key thing in analytics, and I'm sure you will appreciate, is that there's sort of modeling in a theoretical sense, and then there's models and decisions, and making models available to drive decisions. And what we have focused on as a company is that latter part. How do we understand the analytics that are required for a given decision, and how do you get that analytic to the point at which the decision actually has to be made? And that led us into the software business, it led us into the decision engine business, and so on and so on and so forth. And we do that in banking, insurance, retail, healthcare, government, and much other places, but predominantly still in the banking world. So as a company, we've been going for quite a long time, and a number of the things that the company has invented over the years, which have then been picked up by other people, have had a significant impact on the way that retail banking operates. So back concept of behaviour scoring, which I will talk a little bit about later on, and from behaviour scoring, the concept of an adaptive control system, which is a concept that I'm sure many of you are very familiar with as OR practitioners, and is now widely applied in consumer finance. We took the decisioning process that occurs today for increasing credit lines, for example, credit limits, I can say, collections actions and so on, and turned that into a decision optimization problem. We were the first company to do that. And then, more recently than that, we've added the first adaptive analytics frauds, or adaptation on the fly. Like a lot of things in the analytic world, and there's a lot of stuff that's only half true. People used to talk about neural networks automatically adapting. We all know that's not really true. But a few years back, we created a mechanism by which we were able to make that happen. And the trick there, again, is not just the mathematics of it; it's the putting it into operation. And I will touch on another development in the fraud area towards the latter part of what we outlined, but it's more recent than that in the latter part of my presentation. And again, there the focus is on how you make these things happen actually in the real world, in the live environment. So, it's all about analytics these days. You've only got to open any journal or anything that's written by the Harvard Business Review, Forrester, MIT, and all these people, and they will tell you over and over again, companies that embrace analytics are going to be more successful than those that don't embrace analytics. Because unfortunately, they don't actually tell you how to do that. It's like a classic advert of here's the strategy, now you actually want me to implement that. Oh, well, that's not part of my job. And so as I said, 50% of what gets written is probably true. It's always full of the usual hype of technology, of Hadoop, and blah, 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 and so on, and social media data, and so on and so on. I can tell you, mainstream banking is a long way away from using social media data, certainly for the purposes of making things like credit risk decisions, which have impact on people's lives and are highly regulated. But I think there's enough momentum that says analytics is important today, as I will show you, certainly in banking, and will become more and more important as we over the coming years, as will more data and so on and so forth. And I thought I would mention here, because I know there's academics and practitioners and what have you in the audience, and maybe you're aware of this and maybe you're not, but one area where that coming together of practitioners and academics has worked very, very well is in this very area of credit scoring and credit control. There's a conference that's run by actually a school at the University of Edinburgh called, I think it's called Credit Scoring and Credit Control, or some such thing. The professor there is Jonathan Crick, and there's another professor emeritus, Lynn Thomas, I believe is now Southampton, who have made that a very, very successful biannual, I should say, conference, and large numbers of people come together, and there's great collaboration between both the practitioners in the industry and the academics. So that's something that people in the audience are thinking about how that all might happen in your world. It probably would be worth a conversation with them just to sort of stand out. And David Hand is the other guy who's in Europe. He's been very big in that, in making all that happen. So, analytics is here. Analytics is going to drive business advantage. So, the question is, how does all that happen in the credit card world? Well, credit cards are actually the single most successful personal financial product ever invented. And they are that because they're simple to use. At the basic level, they're simple to understand. And they're easy and convenient. They're widely accepted. I don't know how many of you look at, you can get newsletters from different news organisations every day, and it never ceases to amaze me how many there are with the announcement of this payment system, some other payment system, some other one, and they kind of come and they go, and the credit card goes on forever. like the old art school dance. And I found this chart in Nielsen as a sort of industry watcher, and I probably should have done the arithmetic on here, but if you do the mental arithmetic, this is projected worldwide purchase volume 2012 to 2018. And roughly in 2012, it's around about $13 trillion. And by the time you get to 2018, it's double. It's roughly $26 trillion. And you can see that the phenomenal growth here is going to happen in Asia Pacific. And that's basically China. So credit cards are here. Credit cards are here to stay. They might change a little bit in the way they work. You know, they go, gosh, the Americans are now getting to the point where we have chips in cards, and there's a little 4-digit number I have to remember. But fortunately, I have one now that works over here, whereas they used to have this American Express card, which is a little iffy as to whether it was going to work or not, but it didn't have a chip in it. So, you know, they may change, they may have chips in them around the world, which they don't always have today. They may operate through near field or some other thing like that. But the basic structure of the product, I don't think is going to change, and it's going to become more and more popular and more important. It's also, I said it was the singularly most successful product, it's also highly, highly profitable. And that is despite the onslaught, in many cases, well-deserved, I will say, the onslaught of the regulators on the way in which credit card revenues operate and raised. So, for example, in the United States, we had the Card Act, followed by the Dodd-Frank Act, and so on, names that you probably have heard or read about in the press, which sort of squeezed down on the way that fees were administered for going over. It used to be possible to authorize, make a consumer go over the limit, and then not only charge an interest on their charging a fee for having done that. And a lot of that has been taken away. But despite that, credit cards remain incredibly profitable. And I couldn't find a British example, unfortunately, but I did manage to find this American example. And if you can sort of see, roughly speaking, the trend. It's not perfect, but generally speaking, 2013 figures are more or less higher than 2012. It's not exactly, it's not uniform across that chart. And that's largely because of the reduction in losses post the runoff of the recessionary period in the 7, 8, 9, 10, the continued runoff of losses. But if you take, for example, Citibank, 3.6 billion in profits, they make roughly 50% of their bank's profits from what they call consumer banking, and roughly half of that comes from credit cards. So consumer banking is a broad church. It involves DDA accounts, as they're known as in the US. It involves all sorts of other banking services, mortgages and savings and foreign exchange and all sorts of other things for consumers. And credit card is the single most important product that they have. The same is true for JP Morgan Chase. It doesn't quite show the second one in next to Bank of America, there between Bank of America and Citibank. But then the ratios are pretty much similar. So again, despite the fact that JP Morgan and Citi and everybody else make less money from fees and such like than they used to, they are still hugely, hugely important to the success of the bank, and therefore the decisions that get made and how they get made is also hugely important. So I thought it's worth now talking a little bit about, so why is it that analytics has been so successful or so necessary in the credit card world? And can we abstract from that some pointers as to the sort of common themes as to why that is the case? And these are reasonably obvious, but I think still worth making the point over. So there's a risk associated with poor decisions and a reward for making better ones. That's fairly obvious. You make a bad lending decision, you lose money. You make a good lending decision, but you make money. And it's not so much that in the personal financial world, it's not so much that any one decision is important, it's the cumulative effect of these things. So if you make millions of bad decisions, that's clearly not a good thing. You make one bad decision, and it's a numbers game. It's an odds. This is all about an odds game. We're not, when these predictions that I talk about are made, it's not a personal thing. It's not that Andrew Jennings is going to default. It's that people that have assessment and that score, as we call it, there will be 1 in 20 of you. We're not saying which one it is, right? So it's all about an odds game. So it's a cumulative effect. Secondly, those decisions need to be made in a fast and consistent way. So an authorization for a credit card transaction comes through. You can't say, give me time to think about that. You have to have a set of rules that says yes, no, or maybe. Sometimes maybe, no, sometimes it's call me. And it's not necessarily, that's usually not a credit decision, that's usually associated with a fraud decision. And all of those decisions have to get made. So at least, and if you're on a website, you're applying for a credit card or any other financial product, you don't expect it, you expect a decision. Right? And so these things have to happen quickly, and there's a lot of information that has to be processed. You need to know what your customers might do based on what you know about them. So this is the situation where I'm going to make a decision, but that decision is going to alter the way in which you behave. And so what we tend to call action-effect models, and again I will talk a little bit about that later on. But that's also a situation where analytics becomes a critical component of, if I do this, will you do that? And can I make a prediction of what you will do, because that will help me make a better decision. Either because it's a decision that's you're more likely to be favourable towards, or that you will react in a particular way that might be more profitable for the person making the decision, i.e. the lender. Right? If I do this, you're more likely to repay. If I take this kind of collections action or this other collections action, the likelihood of you repaying is higher. If I contact you in an anonymous way, not the way after but through a mobile device, for example, that's more likely to elicit a payment than if I actually make a phone call to you. Talking about being in arrears and just knowing about it, there's psychological things that come into play. Decisions are made by weighing many factors, so there's lots of things to think about. They have to be boiled down. You don't have a lot of time in order to do that boiling down. Therefore, a model is a great way of doing that. And there are potentially a large number of rules and other things that need to be balanced in order to make that decision appropriately. That could just be purely from a business standpoint, but it can also be from a regulatory standpoint as well. Okay. That sort of leads us into this life cycle of growing sophistication of the way that analytics have been applied in the banking industry. And I don't think this is necessarily going to be that much different than the way these things play out in other industries as well. And it's not to say that one thing is better than the other. It's just more like you need to walk and then you run and then you can sprint sort of thing. And so one doesn't replace the other. They are complementary as we move through. So we all know what descriptive analytics are. And so they are the basic reporting that occurs. How many of these have I done? How many people have I rejected? For what reasons? And so on and so forth. Predictive modelling, which is what I've been talking about mostly, I suppose, in passing up to this point, which is the, given what I know today, what is the likelihood of some event occurring during some duration in the future? And the classic example of that in consumer banking is, what is the risk of this person not repaying, given what I know about them today? So, descriptive analytics. What's the average risk of my new business? What's the usage trends? Are they stable? My population, applicants changing in profile and so on. Predictive modeling, what's the risk of this person? Will they be a revolver or a transactor? I'll explain that. A revolver is very important because those are people that borrow on a product, on a credit card, and then there's a revolver. And a transactor is a person who simply makes transactions and then pays off. Which is one of the peculiarities of credit cards. A classic product from that point of view. So it's a reword that. It's a a transactor are likely to be is an important driver of profitability. And then is this transaction fraudulent, for example? And then decision optimization says, all right, if I've got predictive variables and I've got knowledge of what this person is, it still leaves me with the problem of determining what the right decision should be. And I might do that from my expertise and so on. But decision optimization says, can I combine all of that into a model, an influence diagram, a decision model, depending on what language and lingo you want to use, and then I can solve that decision model. And having solved that decision model with some objective function like maximizing profits or maximizing dollars collected, pounds collected, euros collected, and so on, I can then determine what action to take for what individual. And I can do that statistically rather than simply by my own intuition. And these decisions take place across the entire life cycle of a customer. So the life cycle of a customer is you find them and you originate them, you sign them up. In other words, origination is the name for signing people up. And then the decisions are the basic simple decision is accept, reject. But once you get into the decision modeling end of things, not only are people making decisions about should I accept them, but they're analytically driving the decision as to should I accept them and on what terms. What should the APR be? What should the credit line be? Such that whatever the objective function is, will be profitability over some period of time that you calculate from those that you've already taken on. Once you've got them, you have to manage them, and then managing a credit card relationship is understanding the risk as it develops. How do I alter the credit limit of that individual up or down, as the case may be? Do I change the terms in some way, the APRs, because in certain places risk-based pricing is very common. How do I understand the probability of this person going away? That's a subject that could be the subject of an hour's talk on its own, because what we mean by going away in a product which can have, you actually have to terminate your credit card in order to attract you. So like your wallet or in your pocket, but you stop using it. It's not like a telephone thing where you have a contractual termination. You're not really driven to have a contractual termination. So defining what attrition is actually quite an interesting and complicated area. But there are models that drive all of that determination of what offers and what actions happen. And then finally, for those people that don't repay or fall into arrears for some length of time, there's all sorts of models that drive what action should be taken, what priority should be applied to that person. If I get to the point where the debt is written off, how do I collect that debt? Do I outsource it to a debt collection agency? Do I keep it in-house? All sorts of things. And the whole process, from beginning to end, is driven by analytic models. Take those analytic models out, and the industry wouldn't collapse, but the scale would almost be impossible to manage because of the speed at which the decisions have to be made and the volume at which the decisions have to be made. So those of you who are old enough, how many reunion tours have the Eagles done? But on I think it's Hell's Freezes Over, they say something like, "This is where it all began." They played Desperado or something like that. Anyway, so this is where it all began. In the credit scoring, in the credit card world, it all began with an application form. And it all began with people running around taking microfiches of application forms and keying in all that data manually and so on and so forth. Because now it's all in the system. And the data on that application form is then used to drive an assessment of that individual's risk. Now, over the years, the balance of the information that's been used has changed because it used to be almost entirely things that are on there, like, who are you, where do you live, how long have you lived there, how long have you been in your bank, how long have you been in your job, what is your job? All things which are some of those things are difficult to categorize. What job do you have? It's going to be fairly crude. Are you a homeowner? It used to be, are you male or female? That's not allowed anymore, anywhere, pretty much. Some countries still allow it, but not here. It's certainly not in America. It certainly isn't. Actually, it's a great example of the detriment of regulation because females are actually better risk than males, and so not using that information is not a good thing for a female. moved now towards that automated gathering and analysis of that information, because that's objective and not subject to the same degree of any manipulation as what could be certainly here on an application form. And then once, so that's called application scoring. And then once an account exists, then the assessment of risk moves not from that, away from that type of information towards what you actually do. So what you actually do is the kind of things that are recorded on your statement. So then so-called behavior scoring looks at have you repaid, what balances do you have, how much do you repay each month, what's the trend of that, how much have you paid in the last 3 months relative to what you paid in the prior 6 months, one divided by the other sort of thing, so you can get a trend of what's going on. And in all of these cases, it tends not to be a single scorecard or a single model. It's a suite of these things, so there might be a dozen models, say in a behavioural scoring suite. There may be a dozen different models for different segments of the population because they behave slightly differently. They have different population odds, meaning that they're in that segment, the ratio or overall ratio of goods to bads is different, good payers, bad payers is different. Or a number of different statistical things which mean that if you separate that group out, you can get a better overall picture of what's going on than if you lump everything together into one model. And then each of those models, but come back to the point I made at the beginning, those models then have to drive a decision. So if I kind of build those in a separated manner, that makes life very, very difficult for me. So what then happens is that those models get aligned to a common standard. So that we can say, if we're talking about scores, so if the output from that model is 300 or 400 or whatever that aligned are, it is arbitrary, of course, right? You choose a scale. The 300, the 400, the 350 or whatever it may be means exactly the same thing in odds terms, irrespective of which model it came from. Now, the distribution of scores changes between models because some sections are more risky than others, but the median any one given score is the same, and so that makes it much easier to drive consistent decision making. Problems formulated in roughly the same way. You've got people that you know about, and you know about them at a given point in time. It's called your observation period. And then you look forward, and you say, how did they perform X number of months into the future? And then you call the performance period, and you classify people. And you go back to what you knew, and you try to predict what actually happened. The devil is in the detail here, because that sounds like it's pretty trivial and easy, but it's not as easy as it sounds, because understanding what that performance period should be is not necessarily always that obvious. Determining exactly what your good definition is and your bad definition is not necessarily that straightforward. I talked about attrition as being an example of that. And it comes back to thinking about these things in business terms. And a general way of thinking about it in risk is, would I want to do, if I know what was going to happen, would I want to do business with this person? And if the answer to that question is no, then that's sort of a way of saying that's a bad repair. And if the answer to that is yes, it's good. And then there's usually a group in the middle where you don't know, which could be determinants, and take those out of the model development. Okay. And this sort of gets more complicated when the regulators get involved, and I'll just touch on an example in the US where now the latest thing that's beginning to gather steam is a thing called disparate impact. Disparate impact is all to do with making decisions about protected classes. And you have to have a business reason. The business reason is fair enough because I'm lending money and I want to differentiate. I'm going to discriminate against somebody because I'm going to say no to them and yes to those people. Disparate impact is if you do that using criteria which have a disproportionate impact on certain classes of people. And so picking what variables end up going into these models can become quite tricky because you can't use things that somebody could point at and say, you can't do that because that's sort of surrogate for some other thing to do with somebody's ethnicity or their age or whatever. There's various things to define same. You end up with a model that says I can rank order anything that comes through the door, I can rank order it, and I can tell you the odds of that person repaying or being a good or a bad, depending on how that was defined, over some period of time, depending upon what that performance period was for the model. And as a result of that, it becomes nice and easy to make a decision. I can say, I'm prepared to accept everybody that's got a score above 220 because at odds to 10 to 1, that commercially is viable for me to make money. Anything below that is not viable, and so I decline those people. Right? And so it becomes a nice, in theory at least, simple metric that then is used in conjunction with a bunch of other information to derive what limits will be applied and so on. And the technology that's used, I think I might have let this slip a little earlier on, is a scorecard. Now, scorecards are, how do I describe it? I mean, we have our own way of doing this. We use an optimization algorithm to do this because it makes it much easier for us to be able to impose certain constraints and things on the patterns of the weights that come out. So this is a little snapshot of what a credit bureau model might look like. It's got payment history, outstanding debt. Kind of obvious stuff that you'd expect to be important. And the scorecard, the great advantage, and you'll hear, when I go back to the great press and what have you, you'll hear lots of discussion about machine learning, all those other kind of things. And FICO, we do lots of that. In fact, we've actually developed ideas where we take machine learning algorithms and we turn it into scorecards, we turn the output into scorecards. The great thing about the scorecard is twofold. A, you can understand it. I can give that to a business manager and say, here are the things that drive your decision process. I can't give them a neural network and say, here's the things that in the same way. I can't give them random forest model or a stochastic gradient boosted model, whatever it may be, and say, here's the things that drive your decisions. This I can. And it also means I can give it to a regulator he or she is intimately interested in and wants to know every last thing that's in there in order to be able to say the way that you do things is proper and fair and you develop that model correctly. And the second thing which is good about scorecards is that they are engineerable. So it's much easier to say, gosh, right, the data, and it probably wouldn't happen in a credit bureau, but it might happen in a smaller sample of a particular lender. You might see some weird stuff occur, like number of months since the most recent derogatory public record, where somewhere in the middle of that thing, you get a points reversal. Because you expect the points to go up. Higher points means lower risk, I should say. You expect the points to go up the further out, further away that derogatory thing happened, until it's sort of aged off. Well, you might find something weird occur, just because of the data sample, or something different that happened in the origination process at some point in time. And you put your thinking cap on and you say, well, okay, we need to be data-driven here, but on the other hand, we actually need to use our common sense as well. We don't think that's really the true picture. It's not going to be the true picture going forward. And so we want to be able to engineer that number in order to create something which makes common sense. And the concept of a scorecard, and particularly the way that it's harder to do in a lot of other ways to build scorecards from district regression, and each one of these is a dummy variable and so on. That's one way of doing it. We have a proprietary way of doing it, and that makes it sort of easier to say, I want the pattern of weights on this variable to be monotone, increasing, decreasing. I want this variable to be no more important than X. Because sometimes you get situations where one variable is so important, it kind of dominates the entire thing. And that's not good for stability or a number of other reasons. So they're kind of nice statistical tools to be able to engineer and create a robust result. Okay, so I'm going to get going here. So now what actually happens? Once you've got this credit card, what happens? Right, so you swipe it, and if your merchant after daily, it's a bit dodgy. He has a thing called a merchant acquirer. And a merchant acquirer takes the transaction as it comes through, and that's basically his bank from the purpose of this transaction. They're the ones that are going to pay him the money. The merchant acquirer sends it off through the rails of the network, be that Visa, MasterCard, Discover, American Express, whoever, so on and so forth. And they, in turn, route it to the people who actually issued the card. Barclays, HSBC, RBS, whoever it may be. RBS look you up, and they say, we'll get to what they do in a minute, and they say, we're good. And then that flows all the way back through to the merchant and back to you, and it all happens like that. Okay. And then you're assuming that it's good, your services or product or whatever is delivered, and overnight, settlement occurs between the merchant acquirer and the merchant. There's a deduction from what the merchant gets paid in order to pay the merchant acquirer for their services, and the card issuer and Visa for the purposes of having the convenience of the merchant being able to make that transaction, and so on, so the merchant payment. So Arthur may receive 95 pence on the bank, for example, and the rest of it gets dispersed from the other players. So when that transaction comes in, what type of decisions are made? So there's a credit decision that gets made. In other words, have you got the available credit in order for that transaction to clear correctly? And then there's a fraud decision that gets made. Is that really you at the other end of that credit card? So let's talk about that. So the way that decisions get made, this is a really, really simple example. I kind of alluded to this a moment ago. That there's these predictive models that are being used, but there's also other data that occur, and it usually gets set out in the concept of a decision tree. And this is very, very simple. These things I've seen in organizations where I could almost roll it across the floor. And that's a problem. So you get processed down through some logic like this, and at each endpoint there's what's a scenario or an action that occurs, and that action could just be yes, no, it could be action, it could be more complicated than that, it's yes, and these terms and conditions and so on. And then that gets pushed all the way back around the system. Now, I talked earlier on about adaptive control. So if you only do things one way, you only know one way to do things. Okay? So the concept of adaptive control is to be able to say, I want to be able to vary these decisions in some systematic way so as to be able to learn what goes on. So I would ordinarily give this person a credit line, a limit increase of £100 or £200, but I'm actually going to make it £300. And I'm going to do that in a controlled way, and I'm going to do it on a group of people that are, the theories are otherwise identical to the ones that I'm doing the £200 on. And I sit back and I wait and watch. And I do that on a systematic basis, and I run a number of these experiments, and then as I learn from those experiments, I can then adapt and improve the way that I make decisions. And this concept has delivered billions of dollars of revenue and profitability for financial services, credit card in particular, but financial services in general. His ability to experiment, wait, watch, and do all of this without getting the IT department involved. The whole point here is that the user goes in and makes these changes, and there's also some sort of audit and governance process to make sure that you're not doing something that looks obviously stupid, but otherwise it's abstracted from the IT thing. And it can happen quickly, and the results get reported on a regular basis and in an automated fashion. So this loop, this learning loop, as it became known, of experimentation, actions, reactions, data, new decisions, and so on, is very, very important. And as a result of that, you can track one strategy against another, a champion as it's called versus a challenger. You can figure out which ones work best. Now, the reality, of course, and this is highly simplified, the reality is that really, even though the current strategy, or the new strategy in this case, because this is collections, is the new one is actually doing better than the old one, balance is delinquent. It's not as simple as the new strategy dominates the old one. It can be interpreted that way, but if you're really clever, it's about which pieces of the new one dominate the old one. It might dominate in aggregate, but it doesn't necessarily dominate in all dimensions. So understanding which sections it really worked on and which ones it didn't becomes important. Now this this can get out of hand. And the reason it gets out of hand is because it's very, very complicated, and there's a limit to the, what I call the frailty of the human mind. There's a limit to how much of this you can actually think through, and these strategies, these constructs, become highly, highly complicated. So I have to run back now, you can virtually have all this across the board. You say, what on earth goes on? And actually nobody knows the answer to that. And that's now a problem, but it's obviously a governance problem, it's also a regulatory problem. So it doesn't quite show up. This is a picture of an analyst wall in FICO. These things here, these are all of these decision trees, and they're pieces of one pushed together. So how do we solve that? So one way to solve that problem is this concept of decision optimization. So we move from the predictive model to the optimization and determination of the decision. And the way that works is through a thing called an influence diagram, which I'm sure many of you will be familiar with. And you think about that as, well, what do I know? What actions am I going to take? What models do I need in order to model the decision and the impact of the decision? What things do I need to calculate as interim values? And what ultimately is the objective function of profit, the profit over the next 12 months? And what I know about this person is I know what's on their master file, which is that's your accounting record. I know what's at the account. I know what happened at the credit bureau. I have some information about previous actions that I've taken. I've got the things that I'm trying to decide, and then I can link all that up through these models. Now the models in the red here, this is where these things to action effect models come in. Because if I'm going to increase your credit line, that actually has an impact on the balance, and it has an impact on the probability of you revolving, and it has an impact on the probability of you going bad. Because this is the whole point. If I've got £100 to distribute, I want to give that to the people who are going to use it. I don't want to give it to Andrew Jennings, where his credit limit is going to go from 5,000 to 5,100, and his behaviour is not going to change. Because I have to, that's a cost. There's an opportunity cost, and there's a capital cost. We'll worry about banks and capital adequacy and so on. I cannot afford to waste that £100. I have to put it somewhere where I believe it's going to generate income. And generating income in this case means, is my balance going to go up if I give this person £100 credit line increase? So that's an action effect model, and you can only get to that through having done this experiment. So saying, well, I gave this profile of people, this extra, and this is what happened. And so that experimentation becomes the basis of being able to build those models. And so you can solve all of that, and that's what that man over there in the corner who introduced me does as a living, design and solve those things. And the neat thing about it then is that it creates this trade-off curve, this efficient frontier. And I can say, all right, this is what I am today, and by flexing certain constraints, like how much have I got available to lend, even though it might be profitable for me to have a overall portfolio rate of 5%, I really only want to have 4.5%. So if that's a constraint on my problem, what does that mean in terms of how I can then make decisions and allocate my capital? And the model then becomes a simulation for you, whereby all of those trade-offs can be examined and ultimately optimal, using that word lightly, what does that really mean? An optimal model can be, or strategy I should say, can be derived, and then that strategy can be computerized at the press of a button and then implemented into a decision system equally at the press of a button. And as you can see, it creates big benefits, 47 million incremental profit over 3 years, 390 million incremental balances. This is a real example over 3 years on a portfolio of 3 million. 3 million is not, by world standards, not big, by UK standards, it's not a particularly huge portfolio. Chase, for example, is not 50 million. So the benefits that the financial benefits that have come from this type of approach are huge. All right, I've got my eye on the clock, and I think I only started 5 minutes late, so I can take 5 more minutes, that'll be good. So let me switch gears. Fraud. So the other decision that gets made is this fraud decision. So all that stuff was, has the person got the right credit Sometimes those models will be, those credit line optimization things will be brought up in real time and say, no, they haven't, but you know what, if they were to ask, we would, and so therefore, we'll make that decision on the fly and authorize that decision and make a credit line increase decision at the same time. Fraud is very much like that. So fraud needs to be an instantaneous decision. And why is it important? It's obviously important from a risk standpoint, from making losses here. We've got to fight the bad guys. But it's also a reputational risk. I don't want to be seen to be the leader of the pack in terms of fraud losses. That doesn't sound good. It doesn't come across as well to the consumer, but there's a lot to be. Increasingly, it's become an area of competition for customer service. It used to be stop fraud. Now it is much more about stop fraud, but on the other hand, I don't want you to annoy the customers. And there's nothing more annoying than a decline, gee, put that card away, get the other one out. That's a bad, bad thing. And so much more recently, that's become a much more important business objective. And it all has to happen in less than the twinkling of an eye. UK data, I'm not expecting you to take all that in, I'm not going to read it all either, but the big growth, the biggest risk these days is in what's called card not present fraud. So this is the internet, or you abroad, or whatever, where you can't be sure because you haven't actually got a physical address. What's called a CNC, card not present. And so how fast does this actually happen? So a blink of an eye is apparently 300 milliseconds. A Google search is approximately 200 milliseconds. I guess that depends on what speed of network connection. Helicopter rotation is 180. This is from our market. 185. I haven't verified these numbers. 185 milliseconds. Airbag inflation is 60 to 80 milliseconds. And fraud risk happens as the dope has to happen in assessments for 140 to 60 milliseconds. And that's part of Visa, MasterCard, and so on and so forth regulations. The issuer has to get all that through, the merchant always has to get that answer back within a certain time scale. If they don't do that, they're out, so they get fined because they're not within compliance with whoever regulations that may be, Visa, MasterCard, and so on. And a piece of kit like the one that FICO has that does this will then have done something like 15,000 calculations in order to come back and say, this transaction is what risk is it of being fraudulent? Now, in that situation, think about the practical issue here. I'm making a transaction. The issuer has got this log of my prior transactions. It's not feasible today, I don't think, to go in and haul all of those out and then do all of the necessary processing in order to come back and create that model, that score, and pass through a number of rules and pass back a decision to the point of transaction. So what happens is that years ago now, FICO created this concept of a profile. And it's a patented approach to how you deal with this problem. And it's sort of like a big data problem before the word big data were even invented, because this all has to happen very, very quickly, and there's a lot of it. And it's not just that there's not so much that there's a lot of data for one individual, but if you imagine let's take Barclays or whatever it may be, or like Scotland, there are lots of these transactions all coming in at once. And so you've got this happening many times within, and each has to happen very, very quickly. So that's why it's a big data problem. So what you do is you have to find ways of summarizing that transaction, and that's what we call a profile. And that summarization is able to get into the nuances of how one person's transactions look different from another. So here we have two people, right? And in-country and cross-border transactions, dark blue and light and sort of palish blue, and they look exactly the same in aggregate, but they're clearly very, very different when you break it down by time. And fraud is all about understanding those differences, and it's all about creating summary variables to do that, and it's all about this sort of recursive variable calculation, and it's all about understanding how to age off prior information, because
you don't simply want to just drop it. One way of aging it off is to say, I take this one and I drop that one. But that's probably not the right. In some cases, if it's purely average, that might be okay. But if there's other things going on, you have parameters that you use to age off the older data so that it gradually reduces its influence rather than truncating its influence. And then that gets pushed into a neural network because there's a lot of interactions that occur in the fraud world, interactions between time, place, and so on and so forth, and a neural network is a good way of uncovering that interaction. It's a good way of making that trade-off between the analytic sophistication that's required and ability to execute quickly. You can calculate the value from a neural network relatively quickly. And for that level of sophistication, the model is a relatively light IT footprint as well, whereas random forests and what have you can have a much bigger footprint, operational footprint, which can be problematic. So it gives you that good trade-off. Now the profile concept operates both about me, but it can also operate on other entities in the transaction. It's not just whether it's me that's there or not. It's that merchant activity. Is this typical for that merchant activity? Is this typical for this ATM? Right? So it might well be that somebody's stood at an ATM and they're putting cards into an ATM and they're taking out £200. And if they're stolen cards, there might be 20 of them or whatever it may be. For each card, there may not be anything out of the ordinary. All we did is profile a card, you'd never find that. But if you profile the ATM as well, it may be very unusual for those transactions to occur in that length of time. So creating all of those profiles of the different entities that are in this transaction are the things that drive the ultimate termination of the probability of this transaction being fraudulent. I thought I'd close by talking about one of the new areas that we've been working on in this fraud detection area. So I said a moment ago that the emphasis has changed now from not just purely detecting fraud, but also this customer service concept. And so one of the things that you're really interested in fraud detection is rare transactions. Things that I don't do very often, but they're not untypical for people that look like me to do. My classic example is buying TVs. Right? We don't go out and buy TVs every day, but most of us in this room have bought a TV at some point in time. No, we don't think of that as an unusual thing. Right? But if you look at your history, it is an unusual thing. So one way to tackle this we came up with is an extension from the idea of text analytics, where you classify documents. And you can look at a document and say, I can classify that document based on its similarity to other archetypes that I've created by analysis of a library of documents, a corpus of text of documents. And so I can say that document is distributed across archetypes. And it's a bit of this, a bit of that, and that helps me classify where, like keywords kind of thing. And so we can do the same thing with a consumer. And here's this rogues gallery of consumers, and here's this doctor over here, and his persona, if you will, is made up of those types of people in those proportions. And so we can, when a transaction takes place, we can not only look at it and say, how does that look like in the history of this doctor, but we can look at it and say, what's the conditional probability of this thing happening, given that they's made up in this particular way? And so essentially what we do is we create an anomaly statistic that says that in addition to what that person did, it actually doesn't look that abnormal, given that they kind of we're each made up to look like other people around us. We're not all as different as we think we are. And so TVs may not be very usual for the doctor, but it might be restaurants or whatever, TVs are pretty normal over here, and so that's okay. So we can look at all these transaction types. They think of them like text. They've got places, and merchants, and so on. Think of it like a text descriptor. And therefore you can create archetypes for an individual and for the population as a whole, and then you can describe this individual in terms of those archetypes. And then what that
And I can push that anomaly statistic into my model, and then I can improve the way in which I detect fraud. So not only does it work in I sort of describe the positive way of it working, saying it really is me buying the TV, and that's not unusual. The other way it works, of course, is the initial driving force for this is that if those archetypes attempt to kind of diverge, if the pattern of transactions that's occurring here, this fellow, diverges significantly, this anomaly statistic gets bigger because it's diverging from what underlying pattern of what we expected to happen for that individual. That's an indication that that is no longer that individual making those transactions. So, here we have transactions 20, 21, 22, 23, and so on, where we exaggerate the drift in the archetype makeup distribution for this person. And I said we don't put either of those particular numbers as a derivation of that, which creates an anomaly value. And then, as that goes up, that helps us say this person is moving away from what we expect that individual to have done, and therefore the probability of fraud grows. Now, the trick here is not obviously the smarts or the idea, coming up with the idea of an application, but going back to the concept of this is all going to happen in 30 milliseconds or whatever it is. The trick really, and there's a patent pending on this stuff, it's not the concept and the idea of the archetypes of language in the literature, right? I've been here for a long time. It's really about how do I update these things in near real time? How do I create approximations, numerical approximations that allow me to update these archetypes? I can't do it every night. I could, but I would diminish the value of it significantly if I did it every night. And the value is actually quite large. So, I'm a bit short of time here, but this is actually for a US credit card model. And you can see that just looking at these relative improvements and these absolute improvements in account detection rates, the number of accounts that are correctly detected relative to the false positive ratio. Right? False positive means they got it wrong. So you want to get as few wrong as possible, and you want to detect as many as possible. So you can see that these benefits are quite large, and those are significant lifts, especially in an area which has been, we've been at this for a while now, and so this idea actually generates a fair amount of value. So, hopefully that's given you some idea of how analytics permeates from one end to the other, everything that happens in the credit card world. And I thought I'd leave you with some thoughts. Where's analytics going? I think what's the watching media and experts call prescriptive analytics, what I call decision optimization. That will be the new meat of analytics. Analytics 3.0 or what have you is what people talk about as prescriptive analytics. It's actually been happening in the credit card world for 10 years. But everybody's now just discovered that fact, and everybody's talking about decision optimization, prescriptive analytics, deciding what to do, not just predicting what might happen. Albert Einstein, so with all due respect to Albert Einstein, intuition. There's a lot of discussion about big data, and all you got to do is throw data at the machine and the world will be wonderful. Well, it's BS. It's just complete BS. Because the role of the expert definitely is not going to go away. You have to understand what drives the business decision in order to create the right model to improve the business decision. It doesn't happen by accident. So, intuition and what we would call domain expertise is a critical asset. And then, systematic, hydromatic, ultramatic, I'm showing my age here, proof. Maybe not. So, systematic experimentation is and will continue to be critical. Generating the right data to solve the problem. More is not necessarily the thing that will solve the problem. Just getting more and more of something that's the same ain't going to make the answer any different. And so being able to systematically experiment in order to be able to correctly do the first one will become a key, and will continue to become a key skill, a sought-after skill. And so, ending on the sought-after skill, anybody who's thinking about becoming a data scientist, fancy word these days, right? An analyst, a builder of models, we want you. Not we, FICO, we FICO want you, but the industry will want you. There is going to be more and more demand. I lose track of the number of times I get asked to be interviewed about what makes a good data scientist, and I think there's a discussion later on. So, demand is there, the salaries and the demand for analytics